All right, sounds great. So hi, everyone. Today I'm going to be talking about Bayesian model stacking and how we can use that in loss development. And in terms of objectives, there's a lot of similarities between what I'm going to be talking about and what Ron was talking about earlier. The intended application of, like why we go through the exercise of loss reserving is a little bit different for our intended applications. And so there's a little bit of a difference in perspective there, but there are also some strong thematic similarities. So a quick outline. First, I'm going to just go through a quick problem overview and why we might find model stacking useful in the context of loss reserving, loss development. Then I'll go through the basics of model stacking, how it works in sort of the vanilla case where you've just got a handful of models in a pool and you're trying to figure out how to weight them appropriately. And then at the end, I'm going to touch on something that is sort of a relatively newer development, which is how you can do model stacking that's covariate dependent, and I'll get in more into that as we approach there. So loss reserving is, or loss development, I should say, is perhaps the more general term, is a problem within the actuarial community that there's a few different perspectives on. Reserving actuaries have one perspective on loss development. It's all about making sure that sufficient reserves are held on the books in order to make sure that the company's able to meet its liabilities. Pricing actuaries have a bit of a different perspective. I come at this from a third perspective, which is from insurance-linked securities. And I'll walk through on the next slide a little bit more of what that difference in perspective is and why it matters. So here we have a happy loss triangle right here. It's just a 10 by 10 loss triangle. And here the data that we've already observed is in this blue color up here, and the I believe it's called whipped papaya color down here in the lower right is the unknown stuff as of a given point in time. So reserving actuaries, their primary concern is basically just the sum of the rightmost column. What is the amount of reserves we should hold? And there's a sigma in there to represent that, although at the end of the day, you can only reserve a point estimate. You can't put a probability distribution on the balance sheet. Reserving actuaries are concerned about the uncertainty around their estimates to make sure that reserves are adequate, even if, to account for adverse development that's within the realm of reasonable possibility, essentially. Pricing actuaries, on the other hand, usually they want to break this down by previous accident year so that then they can trend it on level and do all the other adjustments to their historical data so that they can get a rate indication for the upcoming policy period. And so that's why there's individual green circles to represent that over here on the rightmost column, one for each year. And there's no sigma there because generally speaking, not true in all circumstances, but generally a point estimate is sufficient for applications, or at least that's what pricing actuaries usually get away with when they're looking at losses developed to ultimate. So our perspective in ILS is this red bar down here with sigmas in every single one of them. And the reason for this is that because of the nature of ILS, insurance-linked securities are basically a way of getting capital for insurance companies. That on the one side, you've got an insurer, and they're transferring risk to an investor on the other side. And a lot of the work that my team does is on modeling the financials from the investor's perspective, because investors generally don't know much about property casualty insurance when they're entering into these transactions. So it's sort of our obligation to get on top of that. As it turns out, the overall value of the securities that we're trying to market are super sensitive, not only to the ultimate loss ratio in the upcoming policy period, it's also super sensitive to the actual timing of the claim payments as the losses develop towards ultimate. And it's also sensitive to how reserve estimates from actuaries change as a function of time, and when reserves are going to be, when either adverse or favorable development is going to be recognized in the form of changing reserves. And so we have to worry about the whole enchilada basically in order to do a reasonably good job of pricing these financial instruments that we're creating. A little quick brief intro on ILS. This is not the main topic of my talk, but since I'm here, this is just more gee whiz kind of information. The typical ILS transactions that we do from the insurer's perspective are basically capped quota share reinsurance. So, for example, on a workers' comp portfolio, the insurer might get effectively reinsurance via this ILS up to, say, a loss ratio of 90. At the start of the ILS contract transaction, the insurer cedes some premium over to cover expected losses. The investor puts in some more capital to make sure that the cell that the funds are in is fully collateralized, because this inside the ILS transaction, the claims are being supported by like a segregated cell. It's not a balance sheet. They can't take more risk than they have actually money on hand. So typically, let's say $90 million in losses, the insurer might chip in 60 million in premium, and the investor would put in 30 million to get it fully capitalized. While the funds are sitting in the cell, they can be invested conservatively, and a rate of return that's pretty close to the yield curve, like 1.5% or 2%, might not seem a lot. But when you remember that the investor is really triple leveraged here, because they've got the premium from the insurer that they're getting the returns on, as well as their own capital, that 1.5% to 2% can turn into 5-6% pretty easily, and that's significantly more attractive. As loss payments are actually paid, they're distributed from the cell. And as uncertainty on ultimate losses decreases to a certain point, then the excess capital in the cell is finally released back to the investor. So after 5 years, if it's pretty clear that ultimate losses are going to be, you can't say exactly what they're going to be because there's still some uncertainty, but say it's going to be less than 70 million, then you can push 20 million back to the investor, because at that point, that capital is no longer needed and they can take it as profit. So the reason that we care about model stacking as a potential solution to how we model loss reserves is because there's an interesting sort of way to frame the problem of modeling in general, and say that we have 3 classes of problems. The first class is M-closed. And here it's that we can write down the data generating model. We know what the data generating model, or we may not know, but we know that it comes from a limited, finite, fixed pool of possible candidate models. We can write it down exactly. And then at this point, we don't really need model stacking. All we have to do is pick the right model. If you've got 5 models that are potential candidates, and one of them is the actual model that really is the data generating process, you'd obviously choose that one every time. There's no reason to try to blend models together. In the incomplete case, we can't really write down the data generating model because it doesn't exist, or it might just be extremely difficult to sort of conceptualize. But we can get arbitrarily close we can take a pool of models, and we can, by combining them in clever ways, we can actually get reasonably close to what the actual data generating model looks like. And then down here, there's the M-open class, which is where there is no data generating model that we can speak of. It just doesn't exist. This last class is, I think, gradually being obsoleted by some of the machine learning work that was being discussed in the last talk, because when this came out in 2000 or so, they used an example like a piece of music or a picture. There's no way that you could write a generative model for a piece of music, except now we've got AI, generative AI neural networks that are basically doing that. So, I mean, M-open is gradually becoming incomplete. But regardless, in both M-complete and M-open, the models that we would actually want to use and fit and train, we know are not the true data generative models. And so we know that even if we pick the best one, it's not going to be, super high fidelity. And so for that reason, model stacking makes a lot of sense in M-complete and M-open regimes. If we can get closer to the data generating model by gluing a few models together in a sensible way, why not use it? So, and here I'm going to make a distinction between model blending and model stacking. There have been lots of going back decades, lots of different approaches to taking outputs from several different models and merging them into a single output. And I'll call that blending for the sake of clarity. Stacking is one specific technique for figuring out how to blend these models. And stacking goes back to a paper in '92. And the basic idea is, let's assume that we've got K models and we've got a bunch of predictions from each model. And the form of the stacked result is going to be essentially just a weighted sum over the model predictions. And here we're just forcing the weights to be between 0 and 1, because you don't want weird pathological stuff where you've got negative weights or extremely large, over 100% weights. And then the original idea behind stacking was the way that you get to these weights up here is that you're just optimizing this function down here, which is basically the difference between your stacked predictions and the actual observed data. Effectively, this is just minimizing mean squared error and trying to find the set of weights that does that. And it actually works reasonably well. The problem with this is that model stacking, as it was originally formulated, was like designed to work with point estimates. And we really care about, especially in the work that we do at Ledger, we deeply care about the amount of uncertainty on each of our predictions. And so, when we don't come up with point estimates as a general rule, we are working with posterior predictive distributions. And figuring out how to generalize this idea to posterior predictive distributions is not quite as obvious. So model stacking might seem a little out there. And I apologize, the formatting of the slide got a little bit messed up, but there are a lot of analogs to model stacking that we already use. So like model selection can be generalized to model stacking. And by analogy, that's much the same as if 20, 30 years ago, people would talk about variable subset selection of, okay, I've got a potential GLM that I'm fitting and I've got 10 predictors, which 3 or 4 or 5 of them are going to get me the best performance and which of them can I safely discard as noise. That's kind of gone out of fashion in the past decade or so as regularization has, sort of worked its way into the mainstream. And now, instead of having to say this parameter is in or this parameter is out, we say, no, we're just going to regularize the parameters. And it allows for a natural generalization where you can talk about a model with 7.5 parameters or 3.2 parameters. In the same way, like, parameter posterior distributions are a generalization of parameter point estimates. Instead of having to say, okay, I think reserves for next year, or rather incurred losses at the end of next year are going to be 100 million, you can say, well, here's my distribution. The mean is 100 million. The median is 98, whatever. And finally, there are plenty of methods for, developing estimates of ultimate losses or developing estimates of premium, whether you're going, chain ladder versus BF or frequency severity versus loss cost. And there's already a widely accepted actuarial practice of you'll use several methods, you'll compare the outputs, and then you'll kind of mix them together in the way that you feel is the highest fidelity representation of the data. And so that's kind of like a manual approach to model stacking where it's human selected weights for each of the models instead of letting the data decide. All right, so so as I said before, we care deeply about our posterior predictives. We want to keep them around. We don't want to collapse to point estimates. So in general, we can think of the problem as just like in stacking, where stacking was weighting point estimates. Here, we're just weighting distributions. So again, we've got K models. We are doing a weighted sum over all K models, where it's just weight times the probability distribution. And there's a few ways of doing these weights. One way is called Bayesian model averaging. And this effectively is you're weighting each model by the posterior likelihood summed over all of the observed data points. The problem is this one doesn't work super well in practice for a couple of reasons. Number one, it turns out that as you get more data, this asymptotically converges towards putting all your weight on the one model that fits the best, which is not necessarily the optimal strategy in practice. And then the other reason is that this is super sensitive to the priors that you put on each of the individual models. And I don't mean priors in terms of saying that, we think that model A is X times more likely to be true than model B. Priors in the sense of you could have a scale parameter prior. And if you go from a weakly informative scale prior to a very weakly informative scale prior, it could actually downweight the model in the Bayesian model averaging framework when really nothing has changed. Another option is AIC weighting. And so I assume most of us are familiar with AIC scores, which are a useful way of evaluating models and a useful diagnostic for determining if we're at risk of overfitting by including more parameters. But Kaike actually proposed, well, let's just go ahead and weight the models by their AIC scores and blend models that way. The problem is that AIC scores should be taken seriously, but not literally. If you start putting behind AIC scores, there's a whole bunch of theoretical assumptions that may or may not actually work out in practice, and you can get some really screwy results if you sort of take this on blind faith. There's another result called another technique called pseudo Bayesian model averaging, and this is where this expression right here denotes the leave one out model estimated prediction for each y. So this is fit the model or get an estimate of the leave one out using some other technique for every data point excluding x sub I, and then predict y sub I as if it's out of sample, leave one out cross validation essentially. And then you weight the models based on which one does the best there. This one is more defensible and more reasonable, and it does perform better, but it's still not a perfect answer. So there was the preferred answer is a paper that came out a couple of years ago that they call Bayesian stacking. And here it's much the same. The reason they're calling it Bayesian stacking is that it's much the same setup as traditional stacking, except here you're working with distributions instead of point estimates. You're treating it as an optimization problem over the weights instead of trying to, in all of these other cases, you can just compute the weights. There's no separate optimization step to figure out what the weights are. But here, weights are actually being directly optimized. And what you're optimizing is some score function between your predicted distribution and your observed outcome. So what does that score function look like? Generally speaking, the score function that's preferred is the log score. I mean, just the log likelihood of the observation at each point. The reason that score function is nice is because it's equivalent to KL divergence, and that has a whole bunch of really nice theoretical properties. Just generally leads to, like, good performance, good behavior. The interesting thing here is that if you collapse your predicted distribution down to a point estimate and you take your scoring rule to be mean squared error, I mean, if you assume that your errors are Gaussian, then stacking as originally formulated back in '92 and the scoring thing are more or less equivalent, which is nice. And then the last nice point here is basically, so now we've got like a simplex W over k possible models, and we can use Bayesian MCMC, the same techniques that we use to estimate our individual component models, in order to estimate the best weights that'll do the best in practice. So this has been a lot of theory, a lot of abstract stuff. I like pictures. Let's go through an actual worked example, a toy example. This is not a loss reserving application that's coming in just a few minutes, but this one, it's easier to visualize and helpfully stimulate some intuition here. So let's assume that we've got a model, and the true data generating process right here, where Y is normally distributed with a mean of 1 and a standard deviation of 1.5. Now note that this is not really properly a model because there's no covariate, there's no predictors. It's like a zero input function. So I mean, we're really learning a distribution here, but not a model. But nonetheless, it's easier to visualize this way. And let's assume that we've got 3 candidate models. We're going to pretend here for the moment that we're in the M-open environment where we don't have access to the true model. So we'll try a few. One is that we've got, assume that Y is normally distributed with some unknown parameter mu for the mean, which we'll estimate from the data, and a fixed sigma of 1.0. Another is to say that Y is normally distributed with a fixed mean of 0 and some unknown sigma that we're going to estimate from the data. And then model 3 is assuming that Y is coming not from a normal distribution, but from a double exponential, like a Laplacian distribution, with some unknown parameters mu and sigma. So model 1 is right distribution, potentially right mean, wrong standard deviation. Model 2 is right distribution, wrong mean, right standard deviation. And model 3 is wrong distribution, right mean and right standard deviation. So each of those is wrong and not really the true data generating process, but in a different way. So if we compute the KL divergence for each of these models, how good are each of these 3 models after being trained on 10,000 training examples? How good does it get at replicating the true data process? We see that the model where the mean parameter is free is actually the worst, followed by the one with the free sigma parameter, and then the Laplace distribution actually does the best because you've got location and scale that you can control, and it's only the shape of the distribution that's getting kind of messed up. Here's a visualization of that. This purple line right here is the true model, and then these 3 other distributions are sort of the candidate distributions after being fit to the data that are trying to get towards the model. This one is the one with the fixed mean, so that's why the mean is shifted. This is the one with the fixed sigma, so that's why it's too narrow. And then the blue one is the one with the wrong distribution, which is pretty obvious visually speaking. So we can run this through our Bayesian model stacking procedure, and the results that we get are basically 25% weight on the free mu model, 15% weight in the free sigma model, and 60% weight on the Laplacian model. And this kind of makes sense. Like, it's putting the most weight on the model that makes the most sense, that fit the best the first time around. And when we blend them all together, we get a model that does better in terms of KL divergence to the true distribution, or call it predictive performance if you want, that's better than any of the 3 component models. So we're actually gaining predictive performance by blending and pulling the predictions in this way. This is the same plot as before, except now I've just included an extra red line here that reflects the blended model. And you can see that it's kind of taken a bit of the punch out of the extreme peak right here in the Laplacian model that gets it a little bit closer fitting to the actual target distribution. So there are some broad similarities between classical stacking and this Bayesian stacking. They're both relying on estimates of out-of-sample performance to estimate the weights. As I mentioned before, there's that deep connection between RMSE and KL divergence if you're assuming Gaussian errors. The big difference here is that if this was a classical model and we were just dealing with point estimates, we would actually have a lot of, an infinite number of sets of weights that we could choose from that would get 0 error on our test data set, or asymptotically 0 error as we increase data. Whereas in the Bayesian context, since we don't just care about point estimates, we care about the distributions. No matter how much data you get, no matter how hard you try, when you blend the 3 models up here together, you're never going to get something that is picture perfect, absolutely lined up with the true model. So in the Bayesian context, it's not to say that Bayes is worse. It's just that Bayes is trying to get a broader perspective on the problem that is significantly harder to estimate. So one question is, why stacking instead of regularization? So by that I mean, oftentimes you've got model A and model B, and there are special cases of model C. In the example that I showed, there was a model with a fixed mu parameter and a model with a fixed sigma parameter. Why the heck shouldn't we just fit a model that's got free mu and free sigma? That seems obvious. And there are a couple of reasons why. One is that even if you were to fit the model that's a superset of all of your component models and to regularize the parameters, regularization isn't necessarily a get out of jail free card for over parameterization. If you've got a giant horrendous model with thousands of parameters flying around, if you regularize, you could get noisier estimates than you could by fitting component models separately and stacking. Another reason why is that the model that is the combination of models A and model B might be just horrendously complicated to structure, or just get extremely noisy parameter estimates, or it might not even be possible to write it down in closed form. And finally, in terms of interpretation, it might be easier to explain, for example, you say I put 70% weight on BF and 30% on chain ladder, then going through and explaining that you've got this great model that's a generalization of both of these, and these are the parameters, and here's how you have to interpret them. It's easier to sort of discuss. Now, of course, you can take this too far. There's no real reason I can think of. I mean, you could if you wanted to, but let's say you were just doing OLS and you've got 20 predictors. You would not want to do a univariate linear regression, one with each of the separate 20 predictors, get 20 separate models and then stack them together. No, you just do OLS the first time around. That would yield better performance than stacking in that example. So now I'm going to talk about an actual application to loss reserving and the kind of results we can see. So here, the focus of my talk is on the stacking aspect of it. And so I'm just taking some models from the literature. This is from the CAS monograph that Glenn Myers put out. This is the second edition from 2019, I believe. And he put out 4 models there: his CRC models, CSR, CAY, and IPI. And I've got the definitions here. Basically, this one is just cross-classified on cumulative losses. Alpha here is indexed to your accident years, and beta is indexed to your development lags. Here's another model, the CSR model, where effectively the shape of the development curve can change a little bit as a function of time via this parameter gamma. And then there's the CAY model down here, which is correlated accident year. So here there's a row term that can account for year-to-year correlation. And then he's got a model down here with IPI, where basically they're sharing alpha parameters, and you're fitting paid and incurred losses simultaneously. On top of that, I just threw a couple more in for fun, just to make the pool a little bit bigger. And these are very similar to the CRC and CSR models on the previous slide. The only difference here is that instead of assuming a vector of factors with one hot encoding for the accident year parameters alpha, instead I'm fitting this with the Gaussian process that I'm calling alpha here. That's just a function of I. So I ran a backtesting experiment to see if actually loss if Bayesian stacking could actually get better performance on actual real world loss preserving stuff. So I got a corpus together of a few hundred statutory filings triangles that are completely observed 10 by 10. So this is the most recent 10 by 10 triangles that we have available in statutory data, which starts in 2001 and goes until 2010, just because we have to wait until 2019 to get the bottom right cell in the square. And it includes paid loss and case reserves and earned premium. So we can do this either on a paid loss basis or on a reported loss basis. They come from 4 different lines of business: commercial auto, other liability, occurrence basis, private passenger auto liability, and workers' comp. And these are, reasonably heterogeneous in terms of expected behavior and how long tail they are. And so it's interesting to see which models do better in which circumstances. So here's our starting point. This is ELPD. This is how well in sample the model does. Actually, this is ELPD-LU, excuse me. So this is an estimate of how well the model would do at predicting losses on a leave one out cross-validation basis, fit to each of the triangles in the backtesting corpus. This is specifically just on the commercial auto side, worrying about reported loss. And we see here that the best 2 models are the IPI model and the GLC model. They have a healthy margin over the next model, and then CAY is down here as far as worst performance. We can run this through stacking, and we obtain the following weights. So 60% weight goes on IPI, 20% weight goes on GLC, 10% goes on CSR, and the tail kind of goes down from there. The interesting thing here is that, flip back, GLC was the best performing model. IPI was right behind it. But when we look at the model weights that were optimal, we actually see that IPI gets more weight than GLC, which is interesting. I mean, they're the 2 dominant models in the stacked blend at the end of the day. But it turns out the optimum is to put more weight on the runner-up in this case. This is the same chart as before, except now we've actually got 2 extra rows up here for the stack performance. And this is labeled as in-sample because this is still using in-sample leave one out cross-validation estimates of performance. So this is us just making sure that stacking is actually doing what it's supposed to. And if you're working in sample, you wouldn't be surprised that if you've got a more complicated model that's blending a bunch of stuff together, that it'd be able to find a performance improvement. The other problem here is that we estimated our model weights by using in-sample ELPD-LU, and that's kind of a problem because it's not a terrible estimate of how good your model is at fitting to the data. But what we're really interested in, of course, is extrapolation, not interpolation. And ELPD-LU is an estimate of interpolation. So what we really want to know is, if you've got a loss triangle, how good are you at predicting down into the bottom right where we don't have data yet, and not an estimate of how well does it fit in the upper left half of the triangle where we have data. Of course, fitting well in the upper left is generally a prerequisite to doing a good job of predicting in the lower right, but it's not sufficient to guarantee that it'll be able to extrapolate well. So we can actually take the backtesting corpus, split it in half into a training and a test set, and then actually recalculate model weights that are based on performance on the training half of the out of sample triangles. And here we see that the model weights are a little bit different than last time. And I'm going to hop down here to out of sample performance. And we can see actually that the out of sample, the model performance on out of sample weights is, again, significant improvement over, first of all, it's quite a bit of improvement over the models that we were including in the stacking pool. But it's also broadly comparable to in-sample. So the interesting thing here on this commercial auto example is that this in-sample model weighting procedure, which we know in our heart of hearts is wrong and it's dirty and it's not theoretically, strictly kosher, it actually happens to do a little bit better. I mean, within the margin of error, say, but just a smidge better in actual out of sample performance on a holdout test set than this more responsible method of coming up with weights down here, which is moderately interesting. So all this is for commercial auto reported. This is what the picture looks like for the other lines of business. And we can see here that for 3 of the 4 lines of business, most of the stacking methods provide a clear advantage in terms of predictive performance over the best performing model in the set of inputs. In here, The picture is a little bit muddier when we're looking at predicting on paid triangles. Here it looks like if you're weighting on n-sample, that's actually a really bad idea, and it's actually going to degrade performance relative to if you're doing your weighting on out-of-sample training data. And so it seems clear that there's a reason why we should do things the right way, which is that in plenty of circumstances, the shortcut is going to fall flat. So the last bit of theory I'm going to go through is on context-dependent model stacking. And basically, the idea here is that is the optimal set of model weights on a pool of reserving models going to be the same in each of the following cases? Should we use the same weights for all of our models when we're looking at a homeowner's line of business versus general liability? Or if we're looking at paid triangles versus reported or incurred, however you want to call it, triangles? If you're looking at a portfolio that's only got $10 million in annual premium versus $10 billion in annual premium, what if you're looking at data from the 70s versus data from a few years ago? Or what if you're looking at a book of business that's rapidly expanding versus a book of business that is basically in runoff? And or what if you really care about trying to get a good estimate for the accident year that was 7 years ago versus you want the best estimate for the most recent accident year? All of these things are different, and for each of these, you can reasonably say, of course, given that extra contextual information, you would want to weight different models differently. Now, doing it by line of business is pretty easy. In the examples that I just showed, it was separate model weights by line of business, and each line of business was fit independently. For a categorical, low cardinality variable like that, it's piece of cake to just split the data up, fit separately. But a problem like this, where we're talking about scale and earned premium or exact vintage of the data, this is where it gets a lot more fraught in terms of being able to you can't just take every single portfolio that's got exactly between 10 and $11 million of premium and see which set of stacking weights does the best there, just because it's incredibly thin, it's incredibly noisy. You might have 0 triangles in that range. It's just a mess. So there's an idea called feature-weighted linear stacking, and this was they came up with about 10 years ago, and they actually came up with it when they were working on the Netflix prize. So what basically, instead of having your weights be fixed, this is your model weight, remember, instead of saying that our model weight on the CSR model is going to be 60%, instead you say, well, actually, the model weight is a function, and it's a function of predictors. So in this case, we might want to shove in like earned premium or accident year or development lag, and then that actually gets you better performance. So it was famously sort of discovered in the process of the Netflix prize. This was the competition where Netflix put up $1 million and offered it to anybody who could get better performance on predicting the star ratings of users for individual DVDs than their baseline model. And equally famously, the model that ended up winning the $1 million prize, Netflix never put into production because it turned out to be horrendously expensive computationally. We're in a little bit of a different boat here because we're operating at a much different scale than Netflix. We're not trying to serve up billions of recommendations. We might be just trying to estimate reserves for dozens of triangles. And also the business value of having good estimates here is a lot better. Whereas here, we actually do need to set reserves responsibly. We need to set rates responsibly. Whereas Netflix could just show Tiger King to everybody and not worry about star ratings, and everybody would be happy. I'll back up. So when when Mike invited me to speak, I thought there's this idea of Bayesian higher stacking that's out there. There's this feature-weighted linear stacking out there. I think it'd be really interesting to combine those two ideas in some way, but I hadn't seen it done before. And imagine my surprise and delight and joy when Monday afternoon I got a notification that a Bayesian version of this just got posted on arXiv over the weekend. And so this is now in the literature by somebody who's much smarter than me and can actually work through all the theoretical details. But it turns out this is an interesting and in a valid sort of combination of two ideas. So for the sake of sanity and tractability, we're just going to assume that our model weights are linear. They're just linear functions of our predictors. We can get a little bit fancier here, and basically this is ReLU normalization of this, and this helps get for nonlinearities of our individual predictors. But this basically just helps us fit the weights for each of the individual models. And I realize I'm running a little short on time, so I will pick up the pace a little bit here. This is a diagnostic graph showing which model does better, the GLS model or the CAY model, in a variety of different circumstances. In this case, the x-axis is earned premium, the y-axis is performance. Numbers above 0 mean that GLS is better. Numbers below 0 mean that CAY are better. We can see consistently a pattern here that GLS is better on small volume triangles and CAY is better on large volume triangles. Likewise, we see that GLS is better in earlier development lags and CAY is better in later development lags. And here it's a little bit noisier, but in many circumstances, GLS is significantly better for more recent accident years. Putting that all together, here we actually have a direct comparison of what I've labeled here as stack mixed is this feature weighted stacking, and stack forecast is just the vanilla stacking that I was showing previously. And we see here that when we have a mixed model, it actually, particularly for paid loss, consistently performs every other stacking modality. On the reported loss, the picture is a little bit fuzzier, but it generally seems to be at least competitive with the other stacking algorithms. If we layer all this in, all of these metrics that I've been showing for the past 35 minutes have been LPPD, which is, I admit, a little bit abstract. Let's say you forget LPPD, I don't care about that. All I care about is my point estimate, what's going to get me the best RMSE. Well, this is RMSE right over here. And we see that when we start stacking, we get significantly better RMSE than we would from any of our other individual models. Usually what we'll see is that the performance that we get is slightly better here than the best individual model, but it's still, at the end of the day, a meaningful performance improvement. Like over here in commercial auto, we've got RMSE of like 4.3. Once we start stacking, we can get that down to 4.0, which is meaningful improvement. The last thing I'll show here is that once we start doing all this crazy stacking stuff, we don't need to worry about distribution calibration or anything else like that. These are QQ plots from each of our constituent models up here at top, and then from the stacking models down here at the bottom. And we can see that the stacking models are reasonably well calibrated in terms of distributional performance as well. So when we're doing stacking, the distributions that we get out of the stacking process are actually, reasonably good representations of reality that just happen to be higher fidelity and more compact than the other distributions. Here I just got a couple summary charts that are basically hammering on the same point again. And this is actually comparing our stacked model versus the best individual model in each of these circumstances. So here we're kind of cheating. We're saying, assume that I know in advance which model is actually going to be the best, and I put that up against stacking. It turns out that stacking wins in almost every circumstance. Like being able to drop our RMSE from 10.3 on a single model down to 9.3 when you're mixing. So that's basically the conclusion here. Bayesian stacking can deliver meaningful, valuable performance when it comes to improving models. It's relatively easy to implement. This is off-the-shelf code from existing papers that I'm using here. Stacking is usually easier than actually building a better model, because if you've got a good model, trying to make it better usually involves 10 failures for every success. But stacking is sort of an off-the-shelf way to just automatically get a little extra performance. And by going feature weighted, we can offer additional improvement in some situations. And I believe that's my time there.
Thank you very much. Very nice talk.